If you have an investment portfolio, chances are you've heard of a 60-40 split. 60% equities with 40% bonds and you'll be safe. However, do you realize that the 60-40 split recently had the worst years ever because of the inverse relationship between interest rates and bond prices? Today we're going to talk about the solution and how you can protect yourself without using bonds due to these new risks with the rising interest rates in the market. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week. There are a few things that happen when interest rates rise. Number one is the most painful. The price of goods and services increase, which we've all experienced recently. The second is if you're a saver, you notice that your savings are worth more. You're able to earn more interest on those savings. But if you have an investment portfolio, you may have bonds incorporated in your portfolio. And when interest rates rise, the value of those bonds go down. So what's a solution? What's an alternative to bonds? How do you diversify your portfolio and stabilize those investments?
Prior to last year, bond investments had a run like no other. For 40 years, bond interest rates came down, which means the prices went up. It didn't matter when you got in on the bond train, you made money. But those days are over. The reason this happened is because interest rates, again, steadily came down. That's probably not going to happen for a long time.
We all know that interest rates are on the rise. They've been on the rise for a while and they're going to continue to go up until inflation gets under control.
With a small interest rate increase last year, the 60-40 portfolio split had its worst year ever. And that's not even taking into account the rise in interest rates since January 1st of this year.
Leave us a comment down below. Do you have a 60-40 investment portfolio? And if you do, what impact have these rising interest rates had on your portfolio? Now, the point of the 60-40 split in the portfolio is to have some riskier investments and the bonds to balance it out with some more stability. However, what happened last year is we had volatility in the riskier investments, the equities, as well as volatility due to the interest rate rises in the bond market. So this bears the question, if bonds aren't stable anymore and we're adding them to the portfolio for stability, what do we use to replace the bonds to add stability and keep our money safe?
Most investment managers talk about diversified portfolio, but how do we diversify our portfolios in a way that introduces stability to our portfolio?
One way may be with a specially designed whole life insurance policy designed for cash accumulation. And you may be wondering, what does whole life insurance have to do with investments? Whole life insurance is a terrible investment. And that in fact is true because investments inherently have risk. But what the whole life insurance policy is actuarially designed to get better and better year over year.
And the fact of the matter is, whole life insurance is uniquely positioned to take advantage of increasing interest rates. You see, when interest rates rise, the insurance company doesn't have to sell the bond. They're going to hold the bond to maturity. They can utilize the bonds that are maturing to reinvest into higher interest rate bonds, or they can utilize those bonds to pay expenses. So it's an old money, new money type phenomenon. But the point is, because the insurance company has that option, they don't have to sell the bonds before maturity and therefore realize a loss. And in essence, what you're doing is you're giving the interest rate risk to the insurance company, who is uniquely positioned to accept that risk because they don't have to sell the bonds.
Here's the long and the short of it. In rising interest rate environments, the insurance company is able to take on that bond interest rate risk and come out better on the other side. You're able to transfer that risk to the insurance company. But what happens in low interest rate environments? Well, whole life insurance policies designed for cash accumulation are a great way to warehouse your wealth due to their many benefits. We have tax-deferred growth within the policy. We have an actuarially designed policy that's guaranteed to get better and better every year. We have dividends that once they're credited can never go away. We also have tax-free access to the policy cash values via the policy loan provisions. And then at the death of the insured, we have the opportunity to recapture all of the costs associated associated with the death benefit costs, as well as any loan interest that you paid throughout your life, you have the opportunity to recapture that and keep it within your family at the insured's death.
You give the insurance company the interest rate risk. You give the insurance company the portfolio risk, and you give the insurance company the opportunity cost risk. They're accepting all the risk because they're uniquely positioned to accept that. And it adds stability to your portfolio, plus you get a death benefit.
If you'd like to learn more about this positioning, check out our website at tier1capital.com. Also, if you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.